Moss Adams is pleased to present another in our ongoing series of continuing professional education webcasts. Our presentation will start in a few moments. Before we begin, here are a few things to keep in mind. You can customize both how you view our presentation and how you interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can also adjust window size and placement. At the bottom of your screen, you'll see a series of icons, each relating to a different aspect of our session. For example, you can click the file folder icon to download the group attendance sheet and a PDF copy of today's slides. You can ask our presenter questions during the webcast by clicking Q&A in the bottom left-hand portion of the icon bar and typing in your question. We'll do our best to answer all questions during the presentation or follow up via email. If you experience technical difficulty during today's presentation, refresh your browser by hitting the F5 key. We'll ask polling questions throughout today's presentation. Per the National Association of State Boards of Accountancy Webcast CPE standards, CPE credit will be awarded based on your participation in these polls. To respond to a poll, click the button next to your answer. If you're attending this webcast in a group, in order to receive CPE credit, you must complete our attendance sheet, available in the file folder icon at the bottom of your screen. Please have all group members sign the sheet, and please remit only one sheet per group. Also note, today's session will offer you 1 CPE credit. To receive credit, you must meet the requirements as specified by the National Association of State Boards of Accountancy. CPE credit can be awarded only to participants registered as themselves and is not available to participants who view the on-demand version. We'll track your progress and alert you when you've earned CPE credit. You can then click the certificate icon to open a PDF file you can save to your computer. We'll email a copy of your PDF certificate in 2 weeks if you can't download it today. As a reminder, the presentation you're about to see is not legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances.
Good morning and welcome to today's webcast, Not-for-Profit Accounting and Auditing, Spring 2016 Update. I'm happy to introduce today's speakers, Liz Dollar and Ali Chalak. Liz has practiced public accounting since 2000. She is the lead assurance partner for our foundation sector. Her focus is financial statement and compliance audits for not-for-profit organizations, including foundations, multi-service not-for-profit entities, associations, research institutes, healthcare organizations, and universities. Liz is a sought-after speaker for a variety of industry group conferences and has served as an instructor and lecturer for the firm's not-for-profit and government groups. Ali has practiced public accounting since 2006. He focuses on financial statements and performance audits for not-for-profit and governmental organizations and leads and manages audits of private and public foundations, research organizations, international NGOs, and higher education institutions. Ali has led training on accounting and auditing topics for Moss Adams professionals, as well as clients and industry organizations. Ali, I will now turn the line over to you to begin today's presentation.
Thank you, Emily. Good morning, everyone. Today, we will be discussing recently issued standards, the FASB Not-for-Profit Financial Statement Project, and other active projects.
So first we have a polling question, just to kind of get an idea of who we have listening today. If you can answer, what type of not-for-profit organization do you represent? So we have foundations and grant-making organizations, higher education institution, social service organization, research institution, trade association, or other. And just as a reminder, CPE credit will be awarded based on your participation in the polls, so please click on the button next to your answer and then hit submit, and we will give you a few minutes to answer and then see who we have on the line today. All right, everybody got their answer? Okay, so looks like predominantly we have higher education institutions, some foundations and grant-making organizations, and then quite a bit of other as well. So welcome to everyone, and hopefully we can hit something for everyone on this call today. So. All right, Ali, I'll let you take us through some of the recently issued standards.
Thank you. During the first segment of the webcast, we will be discussing the topics listed on this slide. Please note, these are not all recently issued ASUs. However, these ASUs has more applicability to the individuals on this phone and in the not-for-profit industry. We will go through these in more detail in the upcoming slides.
All right, we have another polling question, so we're going to front load here. Do you have contracts with customers? Yes, no, not sure. And this will play into some of the new standards surrounding revenue recognition. So we kind of wanted to get an idea of whether or not you have contracts with customers, and we'll talk about customers are, or if you don't. And so we'll give you a few seconds to get your answers in, so you get your CPE credit here, and then we'll go through the standard on revenue recognition. So yes, no, not really sure. All right, so over half of those on the line said they do have contracts with customers, and so that means you should probably listen to this revenue recognition discussion, because that's what this new revenue recognition standard focuses on. So Ali, why don't you take us through that?
The revenue recognition ASU primarily focuses on 4 key areas. The first is the move from rules-based accounting approach to a principle-based focus. The core principle of the new standard focuses on the contract between the not-for-profit and its customers. Second, the new standard resulted in a convergence effort between the FASB and the International Accounting Standards Board. Third, the ASU will not impact all revenue sources, which we will discuss in the upcoming slide. However, it will impact all not-for-profits, some more than others. Lastly, there is a 5-step revenue recognition process, which we will discuss at a high level. Number 1, identify the contract with a customer. Second, identify the performance obligations in the contract. Third, determine the transaction price. Fourth, allocate the transaction price to the performance obligations in the contract. And fifth, recognize revenue when or as each performance obligation is satisfied. The effective date of this ASU for public entities are annual reporting periods after December 15, 2017, and for non-public companies 1 year later. Certain types of revenue streams have been scoped out of the ASU. The ASU excludes lease contracts, insurance contracts, financial instruments, for example, derivatives, guarantees, and non-monetary exchanges. Further, the ASU scopes out contributions and collaborative arrangements. Contributions is scoped out because revenue is defined as inflows or other enhancements of assets of an entity or settlement of its liabilities from delivering or producing goods or services. Since contributions are both voluntary and non-reciprocal, it is for that reason scoped out. Examples of revenue that are in scope would be membership revenue, subscription fees, product and services, sponsorship, tuition, advertising revenue, licensing, and specifically contracts greater than a year. Under this ASU, the disclosure impact will affect all entities. Some organizations will be impacted more than others. The ASU requires disclosures to include qualitative and quantitative discussions regarding revenue. The qualitative aspect would include geographic regions, product line, customer type, timing of revenue recognition, sales by channel, and other breakdown that would be helpful to the users of the financial statements. Qualitatively, an organization would disclose information about contract balances, timing of future revenue recognition, and the number of contracts it has. So you will see under this ASU greater disclosures in your financial statements as a not-for-profit organization. The next topic we'll be discussing is going concern. In regards to going concern, currently there is no guidance in GAAP about management's responsibility to evaluate whether there is substantial doubt about an entity's ability to continue as a going concern or provide related footnote disclosures. The amendments in this update provide that guidance. In doing so, the amendments should reduce diversity in the timing and content of the footnote disclosures. The amendment requires management to assess an entity's ability to continue as going concern by incorporating and expanding upon certain principles that are currently in U.S. auditing standards. Specifically, the amendment provides a definition of the term substantial doubt, require an evaluation every reporting period, including interim periods, provide principles for considering the mitigating effects of management's plan, requires certain disclosures when substantial doubt is alleviated as a result of consideration of management's plan, require an express statement and other disclosures when substantial doubt is not alleviated, and requires an assessment for each period of 1 year after the date that the financial statements are issued. The Discontinuing Operations ASU changes today's guidance, and in many cases is expected to result in fewer disposals being presented as discontinued operations. Under the revised standard, a disposal of a component of an entity or a group of components of an entity shall be reported in discontinued operations if the disposal represents a strategic shift that has or will have a major effect on the entity's operations and financial results. Major effect on the entity's operation and financial results occurs when the component of the entity meets the criteria to be classified as held for sale, is disposed of by sale, or is disposed of other than by sale, for example, abandonment. The concept of strategic shift is intended to be entity specific. Once it is determined that a strategic shift has occurred, it must have had or have a major effect on the entity's operations and financial results to be considered a discontinued operation. This ASU is effective for disposals beginning in fiscal year end 2015. Extraordinary items in topic 225 simplifies income statement presentation by eliminating the need to determine whether to classify an item as an extraordinary item, and also aligns U.S. GAAP to international accounting standards. Under current guidance, a reporting entity is required to separately classify, present, and disclose extraordinary events and transactions. But in practice, few items meet the criteria for this presentation. The board said that eliminating the concept of extraordinary items will save entities time and will alleviate uncertainty for entities, auditors, and regulators who will no longer need to evaluate whether an entity presented an extraordinary item appropriately. The ASU expands disclosure requirements to encompass items that are both unusual and infrequent, and it also defines those two terms. Transactions that meet both criteria would now also follow such presentation and disclosure requirements. The standard is effective for both public and private companies for periods beginning after December 15, 2015. In regards to consolidation, under the current guidance for consolidation, there was a separate accounting model for limited partnerships and similar legal entities. There was a presumption that a general partner controls a limited partner, therefore consolidates the limited partner, and substantial kick-out rights must exist to overcome that presumption. ASU 2015-02 eliminates the presumption that a general partner controls a limited partnership. A limited partnership or similar entity will be evaluated for consolidation under the voting model if either of the following conditions are met. A single limited partner partners with a simple majority of voting interests, or partners with a smaller voting interest with equity at risk are able to exercise substantive kick-out rights. Limited partners with equity at risk are able to exercise substantive participation rights. Under the ASU, kick-out rights include the right to remove the decision maker and to dissolve the entity without cause. For non-public business entities, this ASU will be effective for annual reports beginning after December 15, 2016, and interim periods beginning after December 15, 2017. The Debt Issuance Cost ASU revises subtopic 835-302 to require that debt issuance costs to be reported in the balance sheet as a direct deduction from the face amount of the related liability, consistent with the presentation of debt discount. Prior to the amendment, debt issuance costs were presented as a deferred charge on the balance sheet. Further, the amendment required the amortization of debt issuance costs to be reported as interest expense. The purpose of the ASU is for presentation purposes and for organizations to consistently classify and report debt issuance costs. Early adoption of this ASU is permitted. The next two slides, we will be discussing the fair value ASU. The fair value ASU eliminates the requirement to categorize investments within the fair value hierarchy when fair value is measured using the practical expedient, NAV. If the reporting entity elects to use the practical expedient for the fair value measurement of certain investments, then the reporting entity is no longer required to categorize these investments within the fair value hierarchy. Instead, the reporting entity discloses its use of the NAV per share practical expedient for fair value measurement, and that the investments aren't included in the fair value hierarchy. Investments for which the practical expedient isn't applied will continue to be included in the fair value hierarchy. Additional disclosures may be needed so users can easily reconcile the total investments categorized within the fair value hierarchy with the amounts presented on the statement of financial position. For public entities, for fiscal years beginning after December 15, 2015, and for other entities for fiscal years beginning after December 15, 2016, this ASU would be effective. This table on this slide being presented represents the fair value hierarchy table. For those investments that are not valued at NAV, they are included in the fair value hierarchy, as you can see in the top half of the table. However, those investments that are held at NAV are excluded. That's basically the bottom portion of the table. It should be noted all other disclosures relating to investments held at NAV would be included in the financial statements. The FASB issued its much-awaited final standard on classification and measurement regarding financial instruments. Changes to the current GAAP model primarily affects the accounting for equity investments, financial liabilities under the fair value option, and the presentation and disclosures requirements for financial instruments. The most significant amendment would be to equity investments in unconsolidated entities, while generally be measured at fair value through earnings. Entities will be able to elect to record equity investments without readily determinable fair values at cost, less impairment, plus or minus subsequent adjustments for observable price changes. Further, there would be a decrease in disclosure requirements surrounding significant assumptions used to estimate the fair value of financial instruments. The classification and measurement guidance will be effective for public business entities in fiscal years beginning after December 15, 2017, and for certain not-for-profit entities, they will have an additional year for implementation. The new guidance would significantly change how entities measure and recognize credit impairment for certain financial assets. Today's incurred loss model would be replaced with one that requires management to estimate all contractual cash flows that it does not expect to collect over the lives of loans and other debt instruments measured at amortized cost. Items that are scoped out would be related party loans and receivables, and also pledge receivables. Trade receivables, programmatic loans, student loans are scoped in. Under the current expected credit loss impairment model, or CECL, an entity would reserve for all contractual cash flows not expected to be collected for a recognized financial asset or commitment to extend credit. The estimate of expected credit loss would consider all contractual cash flows over the life of the asset. Further, the FASB decided that an entity's estimate of expected credit losses should always reflect the risk of loss, even when that risk is remote. As a result, there would only be a limited circumstances in which a reserve of 0 would be appropriate. Management is expected to determine the allowance based on past events, current conditions, and reasonable and supportable forecasts. These estimates would include credit risk of assets held by an entity and supportable forecast of future credit risk. The model is moving towards a more forward-looking information. Lastly, there will be increased disclosures surrounding credit risk and the allowance. Our last topic for this section is on leases. The FASB issued its long-awaited revision to lease accounting. Lessees will need to recognize a right-of-use asset and a lease liability for virtually all of their leases, other than leases that meet the definition of a short-term lease. The liability will be equal to the present value of lease payments. The asset will be based on the liability subject to adjustment, such as for initial direct costs. Lease's accounting is similar to the current model, but updated to align with certain changes in the lessee model and the new revenue recognition standard. Similar to today, leasers will classify leases as operating, direct financing, or sales type. Leverage lease accounting has been eliminated, although grandfathered for existing arrangements. Now I will turn it over to Liz to discuss the FASB Not-for-Profit Financial Statement Project.
Thanks, Ollie. So lots of new stuff happening, clearly, and new guidance to be aware of. But the FASB is also working on the financial reporting project, and I'm sure most of you have heard something about it, but I think we're getting fairly close to actually having a new standard. But just to start, we'll do another polling question. So how familiar are you with the Not-for-Profit Financial Statement Project? So there's a couple options here. I read the exposure draft. I provided a comment letter to the FASB regarding the exposure draft. I've heard of the project. I have not heard about the project. So just a reminder, CPE credit is awarded based on your participation in the polls, so please take a moment and select your answer. We'll give you a few seconds to get those answers in, and then we will check out the results. So everybody got their answer? Hit submit. All right, so not a lot of people read the exposure draft. It was a long one, but most 60% have heard about the project. Another 30%, I will get you up to speed right now. I did read the exposure draft. It was a long read. But just to give you, this is a good overview slide of some of the key changes in the financial statement project. Some history, FASB issued the exposure draft in April of 2015, so we're just over a year ago they issued this exposure draft, which was the first proposed change to not-for-profit financial reporting since FAS 116-117, which you may remember came out in 1993. So it's been a while since they've taken a look at the overall financial reporting for not-for-profit entities. The current guidance, as you can see on this slide, and then the proposed changes, it doesn't look like sweeping changes because some of these are a little different, but we'll go through the main changes. I think that the biggest items that they were talking about changing in this exposure draft related to net assets and the net asset classification. Currently we have the three classes of net assets. You've got the unrestricted, the temporarily restricted, and the permanently restricted net assets. And then going forward, they were proposing two classes, one with donor restriction and one without. The other big change that was proposed in the initial exposure draft related to reporting of an operating measure, and you can see that in the revenue, expenses, and other changes. They were proposing an operating, non-operating standard to go more towards what a for-profit organization would look like. Some other significant proposed changes were relating to the cash flow. Direct method of cash flows was being proposed to be required versus most organizations, I think, currently use an indirect method of cash flow. There was also some proposed realignments of items on the cash flow statement in the areas of moving things from operating to financing to investing. So that was on their expenses. Currently, the only organizations required to present a statement of functional expenses are the voluntary health and welfare organizations, but this exposure draft was recommending that expenses by nature and function be required disclosure for all organizations. There were some changes to reporting of underwater endowments, so endowments where your fair value has decreased below the original gift value, some additional disclosures surrounding those funds, as well as additional disclosures surrounding board designations and information useful for assessing liquidity. So again, a lot of this was one, to provide consistency in financial reporting, as well as to more align the not-for-profit reporting with what for-profit entities are currently required to do, as many board members are for-profit experts and not necessarily not-for-profit, so giving them a little additional information as well. So, the next slide is an overview of what has come in the last year. So the exposure draft was initially released in April of 2015 and was open for comment through August of 2015. FASB received 264 comment letters on this exposure draft, and for those of you who don't know, that's a lot. Typical, I think the last not-for-profit exposure draft that came out was probably the fair value, which Ollie referred to with the net asset value. That exposure draft received 51 comments. So people were reading and commenting on this. Leases, however, which came out in 2010, received over 700 comment letters. So it's right there in the middle. But they did have a lot of comments, a lot of feedback, which varied widely on various areas of the exposure draft. And as they went through the comment letters, they also held 2 additional discussion meetings, one on the East Coast and one on the West Coast, where they had interested parties were able to come and give their feedback on the various areas. And what they ultimately determined was that there were 5 areas that overwhelmingly had support in this exposure draft, and those are listed on this slide under Phase 1. And then there were 2 other areas where the feedback was varied, and there was a lot of not so great feedback in those areas. They felt like they needed to really take those back, think about them again, and possibly do another re-exposure to get consensus in those areas. So Phase 1, they felt like they had support. They really wanted to get that pushed through and get some changes made. And then Phase 2, they're going to go back to the drawing board and really think about those areas again. So we'll go through the Phase 1 here in the next slide so you can see what they're thinking that will come out soon. So net assets, as I said, this was the most significant proposed change in the project and also seemed to have the most support in the comment letters. People really agreed with this or didn't disagree with it. Currently we have the 3 classes at the top. You can see unrestricted, temporarily restricted, permanently restricted. And what the proposal is to reduce that to 2 classes, those net assets with donor restrictions and those without. So combining the temp and the perm into that one with donor restriction category. The issue there is if you have endowments, there's still going to be required disclosures on endowments. Those aren't going away, so your endowment roll forward and those things will still be there. So you're still going to be tracking that, but on the face of the financial statements, you will just have the 2 classes of net assets. You'll continue to disclose the nature and amount of those donor restrictions. So like I said, if you've got those permanently restricted endowments, there will be disclosure surrounding that. You'll still have your temporarily restricted by what the nature of those restrictions are will still be in your footnotes, but the face of the financial statements will be different. There will also be additional disclosures on the amount, purpose, and type of board designation. So if your board has designated funds for endowment purposes, or if you have a reserve designated by the board, there will be additional disclosures on that and how you've come up with that number. So adding and subtracting here with net assets in terms of what's on the face of the financial statements and then what you have to disclose. The next area also falls somewhat under net assets, but they looked specifically at those underwater endowments. So as I mentioned, those funds where the fair value of the actual endowment fund has gone below the original gift value or the corpus. So currently when that occurs, the negative amount or the underwater amount is a reduction from your unrestricted net assets. And in this new proposed guidance, that would move to the with donor restrictions. So you're not pulling that underwater amount out of unrestricted net assets, you're actually taking it from what currently now is temporarily restricted, but in the new proposed disclosures would be coming out of those assets with donor restrictions. And that tended to get quite a bit of support from those people who took the time to comment in the exposure draft, because it seems to make more sense that those assets really do have a donor restriction. They're not coming out of your unrestricted net assets. And when that actually goes back above water, which you hope it will, it's still in that donor restricted section. So that seemed to get a lot of support. And then there's going to be an additional enhanced disclosures surrounding these underwater endowment funds, which really is an aggregate amount of which funds are underwater. So some of your endowment funds are, probably not underwater, and some are. So aggregate amount of that, which is currently disclosed, but also disclosing the original gift values. So the corpus amounts of those funds which are underwater, the fair value, and any board policy to spend from those funds or not, because the way MIFA is written now, you are allowed to spend out of those underwater funds. So currently you don't have to disclose what your policy is surrounding that, but this would just give some additional disclosures surrounding what your policy is. Do you spend out of those funds if they're underwater, or is it your policy to stop your spending at that point when you have funds that have gone below that gift value? The next area that there was quite a bit of support for was just getting some consistency in the presentation of investment returns. Right now, some organizations are showing those investment expenses net of the investment returns. Others are showing the investment returns gross and the expenses down in the expense section. So this was one of those areas where they're trying to get consistency in financial reporting across the sector. And what the proposal is to present investment expenses net of investment returns on the face of the statement of activities. Netting limited to external and direct internal expenses, so any fees you're paying for investment monitoring, and then any direct internal expenses, so that would, if you've got salaries that are being allocated to those investment expenses or expenses returns. Additional disclosures also. So what are you going to disclose? Disclosure of investment expenses is no longer required except for the amount of the internal salaries and benefits that have been netted. So if you do have an internal investment person that you're netting against those, that will need to be disclosed. But there's no longer the requirement to disclose the components of investment income. So you're taking a lot of the disclosures out and then just really netting that on the face of the statement of activities. So I think more than anything, this isn't really new GAAP. It's just creating consistency in the reporting across all organizations. The next area relates to information for assessing liquidity. Right now, there is no requirement to show a classified balance sheet for not-for-profit organizations, but the statement of financial position is intended to be ordered consistent with liquidity. So, cash is at the top, and you go from there. However, what this was saying is the FASB said, investors want to know in a for-profit organization, what's the liquid assets. How do we see that in a not-for-profit entity, and how do we get more clarity surrounding the organization's view of liquidity? So the decisions here really relate to more disclosure surrounding what the organization does to assess their liquidity. So the board said here the entity should define the time horizon it uses to manage liquidity, and this is oftentimes will go with that disclosing if a board has a reserve. What is your reserve policy? How do you, what's your cash flow? Do you look 30, 60, or 90 days out? And then adding some qualitative and quantitative information about that liquidity. The total amount of your financial assets, amounts that are available or not available. So if you've got some restricted items, making that clear on your disclosures that there are items in there that you can't use for liquid cash purposes. And then some qualitative information about your strategy for addressing risks, areas that, like a line of credit that may help you in times where cash flow is tight, and how you use that. And if you do, again, have a policy for establishing a reserve and managing that time period. So that's what the board is talking about. I don't know that they will be necessarily exactly prescriptive on what that's going to look like, so there may be some leeway for you to make some decisions in how that information is presented, but when the standard comes out, we anticipate there will be a few required things and then some areas where you'll have a little more leeway to decide how much information you want to give on the liquidity of your organization. And that'll vary based on the type of organization and the size of the organization and the users of your financial statements as well. Reporting of expenses is another area. A lot of organizations choose to report their statement of functional expenses even though they are not required to, and others don't. So the proposal is that you will need to provide an analysis of your operating expenses by nature and function in one place on the financial statement. So there's currently not a requirement in this proposal that it be an actual statement of functional expenses. It could be on the statement of activities if you provide those by function and nature on the statement of financial position or the statement of activities. You can do that. You could have a separate statement, or you could do a footnote and have a schedule there. And this will kind of vary by, again, type of organization. If you're already doing this, it's not going to be any additional information that you're going to have to add. The exposure draft did provide some examples of how this might look in different areas, and we've got one example on the slide. Functionalization of your non-operating expenses is optional, so I think a lot of organizations already choose to not do that, and they're not going to require you to do that for non-operating expenses. This is really your operating expenses, and then you just need to decide if it makes most sense to have a schedule or if putting them on the face of the statement or in the footnotes makes more sense for your organization. But there are some examples, and there are some examples for various types of entities, foundations versus a higher ed, and so those are in what we've seen so far as the proposed ASU. So they'll give you some guidelines on this and how to present if you're not already presenting a statement of functional expense. Lastly, the cash flow statement. So tentative board decisions on the cash flow statement. The board has decided not to require not-for-profit organizations to use the direct method of presenting cash flows, but instead to continue to allow them to either use the direct or indirect method. So they got a lot of feedback that, this isn't required in the for-profit world. Why are we requiring not-for-profits to do something the for-profit world isn't required to do? So there is still going to, what we hear, tentative decision is that there will still be an option to use indirect or direct method. But if you choose to use the direct method, you will no longer be required to do the reconciliation back to the indirect, back to the direct method. So they are taking something away here, which is, but I think for most of the organizations that we work with, I think they're already using the indirect method, and so I think they heard why are you making a change when it's not really necessary. The other side of the cash flow that they were looking at was moving some things around on where they were being reported. We were taking some things out of the investing section and moving them to operating, as well as taking some things out of operating and moving them down to financing. Those items, the realignment items that they had proposed in the initial exposure draft, have been tabled into that phase 2 area, because mainly the feedback there was, again, why are you requiring to make changes to the not-for-profit reporting that aren't required in for-profit cash flows? So I think what they're going to do there, and there's exposure drafts that have been coming out specifically related to the cash flows, which I think Ali is going to talk about, is that they're not going to make not-for-profits do something different than for-profits in an area where it doesn't make sense, and the statement of cash flows would be one of those areas. So just briefly, phase 2, what they're talking about here is mainly the operating measure section, and they had proposed mission and availability as criteria for determining what your operating measure is, and just based on kind of the clarity of what these items mean for various organizations in our not-for-profit sector. It's so diverse that this is going to be a bigger discussion than just being able to push this in to right now. So needing to think about this a little bit more, but this was kind of what their initial proposal was, and we'll see when and if this comes out again. So there's a typo here, but the expected issuance date of this ASU is by June 30th. They have board members retiring on June 30th, and they want to get this out before that. So we do anticipate that we will be seeing this in the next month. And then the proposed implementation or effective dates for this are for fiscal years beginning after December 15th, 2017. So you're looking at 12/31/18 or 6/30/19 year ends. So a little bit of time to get this ready, but that's what they're proposing currently. So I anticipate we'll see this soon, and then next time we'll be talking about exactly what, instead of guessing, but exactly what's coming out. But that's pretty close to, we're sure what's going to be there when this gets issued. All right, so to make sure you're still awake, we have another polling question, and this is our last one. Who do you think will win the 2016 NBA championships? We gave you all the choices, and the slide's still current, which I was glad. The Warriors, the Thunder, the Cavaliers, the Raptors, or I don't watch basketball and don't really care. Those are your choices. So as a reminder, if you're out there still and want to get CPE, please submit an answer here, and we will give you another second to think about it. It's kind of a close race here in some of these, in this, at least one of these series. All right, everybody. All right. So we got a lot of people that don't watch basketball, which is great. It's a busy time of year to watch basketball, but Warriors have it. They've got their work cut out for them, but I'm with you. All right, Ali, you want to take us through the end here?
Thank you, Liz. The last segment of our webcast, we'll be discussing other active projects. So the first three items, the statement of cash flows, intangible assets, the disclosure framework, are items that the FASB is currently working on. The last topic, the AICPA Audit Risk Alert. This is a document published by the AICPA discussing risks and things to be aware of in the not-for-profit industry group So we'll be discussing these items in greater detail. As Liz mentioned earlier regarding the statement of cash flows, a key goal of the proposal is to bring consistency to all not-for-profits regardless of entity type and structure. The proposal seeks to remedy inconsistencies in the reporting of intermediate measures of operating performance in the statement of activities, including inconsistencies between entity-specific definitions of operations and the reporting of operating cash flows in the statement of cash flows. To accomplish this, the FASB has developed a new proposed definition of operating activity for the performance statement and would require cash flows to be classified as operating using similar concepts. All not-for-profits within the proposal scope would be required to present standardized operating measures. To promote alignment between the statement of activities and the statement of cash flow, the proposal would change the composition of cash flows for operating activities, which in turn would impact the categorize of cash flows. Consistent with the mission dimension used in the statement of activities, capital expenditures gifts of cash to acquire property and equipment, and cash invested in and distributed from strategic joint ventures and similar programmatic investments would be classified as operating cash flows. Similarly, cash returns from non-programmatic investments would become investing inflows, and because interest on borrowings by definition is not directed at carrying out the not-for-profit's mission, all interest outflows would be classified as financing activities. The FASB has asked for comments, and the comment period surrounding this proposed guidance is open until June 27, 2016. In regards to the intangible asset and goodwill, under the proposed amendment, an entity would perform its annual or any interim goodwill impairment test by comparing the fair value of a reporting unit with its carrying amount. An entity generally would recognize an impairment charge for the amount by which the carrying amount exceeds the reporting unit's fair value. However, that amount should not exceed the carrying amount of the goodwill allocated to the reporting unit. An entity would still have the option to perform qualitative assessment for a reporting unit to determine if the quantitative impairment test is necessary. The board also proposes to remove the requirements for any reporting unit with a zero or negative carrying amount to perform a qualitative assessment, and if it fails that qualitative test, to perform step 2 of the impairment test. The comment period is open till July 11, 2016. In regards to the disclosure framework, the objective and primary focus of the disclosure framework project is to improve the effectiveness of disclosures and notes to the financial statements by clearly communicating the information that is most important to users of each entity's financial statement. Currently, 4 sets of disclosure requirements are being reviewed as part of the disclosure framework, which we will discuss on the next slide. Each review will include evaluation of existing disclosure requirements within the topic after applying the concepts in the board's decision process and consideration of ways to promote the appropriate use of discretion specifically within the topic. On September 25, 2015, the board issued an exposure draft of the ASU. The due date for the comment letters was December 8, 2015. The board is currently reviewing the comments, and the board has made no technical decisions as of March 2, 2016. The board's decision process and the entity's decision process are being used together to modify the disclosure sections in the fair value measurement, defined benefit plan, income taxes, and inventory. The last area that we wanted to talk to you about relates to the AICPA Audit Risk Alert. This alert is an important tool to help you identify the significant risks that may result in the material misstatement of financial statements and delivers information about emerging practices, issues, and current accounting, auditing, regulatory developments. I won't be going through each one in great detail. However, there are a couple of items I would like to bring to your attention. The first being capital campaign. During a capital campaign, some errors that were noted were insufficient evidence, not recognizing the full amount of the promise to give, and instead recognizing only revenue to the extent that these payments were received, and not using proper present value techniques. The second item relates to functional expenses. Like all organizations, not-for-profit activities and operations are under constant change. Therefore, current methods and allocations used can quickly become outdated. It is critical that these changes and factors affecting a not-for-profit are reflected in allocations and function classifications of cost. Reviews of allocations of costs and expenses should be performed at least annually to ensure the functional expenses are properly reported.
All right. So we have a couple of questions that have come in, and I just want to follow up on those. There were some questions relating to the nature and function of reporting your operating expenses under the new proposed standards. And one of the questions was, would that apply to private foundations? The answer is yes. It would apply to all organizations. And for private foundations, well, the program typically is grant making, and so that is your program expense, and any salaries related to your staff working on the program would be program-related expenses. And they did give, in the exposure draft, there was a specific example on how this might look for private foundations. So I anticipate in the guidance that comes out when they have decided exactly what this is going to say, there will be some examples for different types of organizations in the guidance on how you're going to report, or how you can choose to report those expenses by both nature and function. And will those match the 990? No, yes, maybe is kind of the answer. There is no right now current guidance that says for the IRS and GAAP are going to be the same for reporting your functional expenses, so you may have differences there as well. One last question that I think we can't really answer, but it was out there, and I think under the revenue recognition standard, federal grants and contracts, are those considered contracts with customers or contributions? And there's a technical resource group for each of the industry areas going over this revenue recognition standard right now, and that is probably the top question that's being asked is the government a customer, or can we scope those out of this revenue recognition standard altogether? So that is being looked at right now, and hopefully we will have some definitive answers on that soon. So thank you very much for listening. Emily, I think you're going to close us out.
Yes, great. Thank you, Liz and Ali, for a great presentation today. As a reminder, if you attended today's presentation in a group and would like to receive CPE credit, you must complete the group attendance sheet in order to receive credit. This is available in the slide deck and handouts icon at the bottom of your screen to the left of the link icon. If you participated as an individual and met all certification requirements, your certificate is available to download now in the CPE icon at the bottom of your screen. Open the icon and click the printer in the lower right corner to download a PDF copy of your certificate. I'll keep the webcast console open for a few minutes to give you time to download your certificate now. A copy will be emailed within 2 weeks should you have any technical difficulties. Here is a link to an online survey where you can provide feedback for today's presentation. Please take a moment to complete this survey as your feedback is very important to us. Thank you for joining us, and we hope you'll join us again next time.